All right, welcome back to the show, guys. Another episode of the Full Subjects podcast. We wanted to take a quick episode as we get to the end of the first month of the year, end of January, just to kind of give you guys a rundown of what's going on in the market, what we're seeing with rates. There have been some huge changes, huge things going on over the last month, and we wanted to just take a quick episode this week to give you guys a rundown on the market and just recap what we're seeing and what we've seen, and then maybe make some predictions or some prescriptions on maybe some creative ways that you guys can be navigating the market if you plan on moving this year or even if you plan on getting into the market this year. So stay tuned for a great action-packed episode. It'll be short and sweet this week, probably only running about 15 or 20 minutes. But yeah, thanks for joining us. As always, this podcast is for informational purposes only. It doesn't constitute legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. And let's get into it.
All right, guys, welcome. As Austin said, we're going to kind of just look at what's happened so far in 2025. Almost through the first month here. Time has flown by, Austin. I don't know about you, but I can't believe we're almost in February.
It's crazy to think about. First month of the year is done. So pretty wild.
Yeah, and it's been weird, and I'll kind of go off topic a little bit here, but the weather's been kind of odd, and I know that people love to talk about the weather, but it's been unseasonably dry for us, like quite cold, quite clear, which honestly I love. To be honest, I'm not mad about it, but yeah, it's been a bit of a weird winter so far, I would say.
Cold and sunny, I don't hate it. It's better than the wet snow. So
yeah, no doubt.
I'd rather put on a sweater than truck around in the snow. So.
Yeah, absolutely. So, without further ado, let's get into it. As always, I'll kind of talk about... Go ahead, sorry.
Are we going to debut a new segment of the show?
We could. We kind of joked about this before. If we do, this is what it's going to be called. It's going to be called Cole's Notes.
The Cole's Notes segment.
Pun intended. The focus... Love it. Let's roll with it. The focus of it today will be interest rates. It won't always be interest rates, I promise, but for now, we're going to talk about that in the segment this week. So let's get right into it. So as always, there's fixed interest rates, there's variable interest rates. Let's talk about both. So fixed interest rates first and foremost. These, of course, are for your people that like stability and they like to know what their payments are going to be because they're not going to change. So honestly, they've been fairly steady to start the year. We saw them come down a little bit at the start of the year and they've kind of ticked up a little bit. And now when I'm talking like movement, I'm talking like 0.1, 0.2% kind of movement. I'm not talking about full percentage points or anything. But we have seen a little bit of a increase recently, and nothing to be alarmed about. It really kind of is driven by what's expected in terms of inflation. So, and why I say that is because let me backpedal a little bit. So fixed rates are driven by bond yields. Bond yields react to inflation expectations. So if they expect inflation to be high, they're going to react accordingly. If they expect them to be low, again, they're going to react accordingly. And we'll talk more about inflation once we jump into variable rates. But for now, fixed rates, I'll give you guys some numbers because I don't think we talk about numbers that much, but I think it's worthwhile to just kind of talk about current numbers. So on like the 5-year fix, which is your most popular product no matter when, like it's maybe not right now, but in general, it's kind of your most common product. You're kind of sitting between right around 4.5% is probably a good number to say, like give or take on the low side, the high side. There's going to be variability to that depending on your type of mortgage. So are you going to be insured? Are you not going to be insured? But that's probably a good baseline for most people. So if you're not close to that number, you should definitely be looking somewhere else. That's probably what I would say with that. And then the last thing I'll say about fixed rates is the 3-year fix is going to be your most popular product right now because most people are speculating that rates might go down. They don't want to be stuck in a 5-year fixed rate. And most 3-year fixed rates are the same, if not even better than 5-year rates, to be honest. So in my opinion, 3 years is going to be a better option right now than a 5 if fixed is the way that you want to go. I know this is Cole's Notes, Austin, but I don't want to just ride this out all on my own. So anything you want to add before I jump into variable rates?
No, I think I think you've put it really well. I definitely think there's an interesting conversation. I know you're kind of going to contrast the two different, obviously, products and maybe what makes more sense. I think typically people like the consistency of fixed, but I think variable might be an interesting option, and I'm sure you're going to tell me why.
Absolutely. So without further ado, and I've said that twice today, and I don't think I've said that twice in the last 2 years, variable interest rates. So I think the first thing that I should really note here is that the discounts on variable interest rates are shrinking. So what that means is whenever you get a variable interest rate, it's based on whatever the prime rate is. And the prime rate, to backpedal even further, is based on what the Bank of Canada sets their overnight rate at. So the current prime rate that the majority of all mortgage lenders are setting their prime rate at is 5.54% right now. And variable interest rate mortgages are based on a discount off of that rate. So let's say you're looking for a 5-year variable rate mortgage. Currently, the prime rate is set at 5.54%. Let's say you get a discount of 0.95%, for example. And I say that because I have clients right now that I'm working with that have that discount. So they're looking at a 4.5% interest rate as of today, because they take that number, they subtract it off of the prime rate. Now, what I'm saying when I say that discounts are shrinking is that 0.95% discount is starting to get less and less. We're starting to see those discounts not be as good. And there's a few reasons for that. So the number one is that there's a lot of volatility in the market right now. Obviously, everyone who is alive probably knows that Trump is now in power and also has talked about tariffs. So there's a lot of volatility around that. And because more people have been taking variable rate mortgages, there's now more demand for them. So now they're pricing them differently because that's how things work. Supply and demand. If people want something more, typically the price of it won't be as good of a discount because there's more demand for it. So that's why we're starting to see those shrink a little bit. Now, that's not to say you shouldn't take a variable rate, but I think that's a really important point to note because time is important in terms of like how long you wait to take a variable rate. Like if you're looking right now, for example, and you plan to buy in the next 3 to 4 months, we can lock you into a variable rate now. And when I say that, we can lock you into a variable rate discount now and protect that discount in case it changes. And if it does change, we know that you get it. So that's why that's important. So as always, variable rate mortgages are driven by, like I said before, the Bank of Canada and the decisions that they make about their overnight rate. So the overnight rate is the rate that everybody hears in the news when they're like, oh, the Bank of Canada's dropped their overnight rate again. Currently, the overnight rate sits at 3.25%, if I'm not mistaken. And we're due for another announcement next week. Surprise, surprise. That's one of the many things that we talk about on the podcast, and we tend to talk about it a lot. So there's two important things to note before we talk about what's going to happen in that announcement. So inflation data, as always, I talked about that with the fixed rates a little bit. Inflation data came in lower than expected in December. Now, normally you would go, okay, that's not a good thing if I want to see rates go down. It's a good thing for the consumer because it means they're paying less money for things overall. Like things aren't going up in price at the same rate anymore. But the reason for that is Mr. Trudeau decided to put in a tax holiday, essentially. They took away the GST/HST on a number of different products, which had an impact on inflation in December. And we're going to see that same impact in January as well. So that is something that we have to note when we're looking at that data. And because of that, we kind of have to read it as not as positive, I guess, as it comes across. And then the other component of that is employment. So employment, again, actually came back in December very strong, which, again, you would say, okay, employment data is strong, which means that the economies should be doing well, and maybe we don't need to lower interest rates.
How much of that, I guess I would ask, sorry to cut you off.
Yeah, please.
This is probably where you're going to lead, but how much of that is probably just people picking up secondary seasonal jobs and stuff like that?
It could be for sure. But I think like the thing that's worth noting more than anything else here is that the labor market is notoriously volatile. So one good month is not enough to kind of change the sentiment in terms of where the labor market's going. So one good month is not going to tell the Bank of Canada, oh yeah, we're doing great, unemployment's coming down. Like, that's not enough data to suggest that. So I don't think that can be necessarily weighed too heavily in their decision. I don't have the current odds of what is expected on Wednesday, but I do think that there's a higher likelihood that we'll see a rate cut than we won't. And we won't see a rate increase, but we might see a hold. And if we do see a hold, then that's fine. Things don't change. But I do still think there's a high likelihood that we'll see one in January. And then we'll kind of see where things go from there. And the last thing I'll finish on here is kind of Canada and the US. We've talked about this a little bit before. I think we had Daniel on and we talked about kind of the differences between the two, the comparisons between the two. So what's worth noting here is that Canada is more rate sensitive than the US, and the rates in Canada, so the interest rates in Canada, are still overly restrictive at what they're currently at. Because I gave the example at the start of my talk on variable interest rates, and I said that you're looking at about, best case scenario, you're looking at about a 4.5% variable interest rate, which is comparable to a fixed interest rate, which is great news, by the way, because for a long time we were seeing variable interest rates be much higher than fixed interest rates. And Austin, where do variable interest rates typically fall in relation to fixed interest rates historically? Better, exactly. Yeah, and that wasn't a trick question. You knew the answer to that, and I knew you did. So that's a good thing. That means that we're getting back to where we would expect them to be. And with the Bank of Canada likely lowering their interest rates more throughout the year, we will likely see variable interest rates become lower than fixed interest rates, barring any significant other changes. Now, obviously the tariffs can have an impact on this if that's what ends up happening, but just kind of looking at it from like current situation, it's expected that we'll see variable interest rates come lower than fixed interest rates.
Yeah, I think that's really well put. Yeah, I think, as much as we're recording this at the end of January, with like a week left, basically 6 days, I think it's very fair to say that when we're recording our next episode on, the end of the week or early February, there'll probably be some pretty big news one way or the other. We'll be talking about a rate announcement. Potentially we'll be talking about, those said tariffs being in place. Obviously, there's some stuff going on in our government right now with a new Liberal leader candidate race, I guess you can call it, because our Prime Minister has announced that he is stepping down from his position. I believe I read somewhere as well that he doesn't even plan on rerunning in his what do you call it? His
riding?
Yeah, his riding. I believe I read that. That may be incorrect, but I believe I did read that, which would be a big change as well. So yeah, lots of potential changes, lots of things going on right now.
Yeah, no, that's really well said. I think we still plan to have an episode in the future we'll try to bring Roman back on. We've had Roman on for 2 episodes. We talked about the provincial landscape, the provincial political landscape, that is. And we're hoping to bring him back on to talk the federal landscape and kind of where we're at now, what we can expect when the government kind of comes back. I think it's in March.
Yeah, March.
And then where things are going to go, because I believe this is election year, right? So
yeah.
October 2025, if I'm not mistaken, is when Canadians hit the polls, assuming nothing happens before then. So there's a lot that's going to change this year, no matter what happens with the new Liberal candidate. But yeah, stay tuned for that. That's kind of a foreshadowing to future episodes.
Sweet. Is there anything else you want to chat about with the Coles notes?
No, that was it. That was my segment on variable fixed, kind of where we're at. But let's talk about the market itself, Austin. So you've had a busy January. There's been lots of action out there. Austin's been posting about kind of his turnout at open houses and kind of keeping people in the loop in that regard. But let's talk about that here. Let's talk about what you're seeing. Are people, quote unquote, running back into the market? Like, what are we seeing in that respect?
Yeah, so it's funny. We got to make a joke about this. You have a Coles Notes segment, and then I have just talk about the market. We haven't come up with a clever name for.
We're working on it.
Yeah, for mine, but stay tuned for that. Yeah, sentiment in the market, I definitely feel like there's a bit of bent up demand. I've had quite a few first-time home buyers that I'm meeting at open houses that are maybe unrepresented or just getting started. Just kind of getting a feel for what's out there. And, as we've talked about previously, there's a lot of inventory that's still kicking around from the end of last year, but also seeing a healthy amount of new inventory hitting the market. So as an example, as of right now, for 16 of 22 working days in the Fraser Valley, we're at 2549 for our listings. At that point in January of 2024, we were at 1630. So a considerable amount of listings. As well, right now we've seen 557 sales processed. There's probably more than that in just the Fraser Valley. I know I've got a couple that are in subject removal right now. But anyway, beside the point. So some bent up demand. When I see those listings being higher, does that surprise me? No, not really. We see quite a big lull in December. So January being more active, a lot of people just holding out for the new year. That doesn't surprise me really at all. I think if we can get more first-time home buyers, into the market, if they feel confident enough with the changes in rates or this being the year that they're getting into the market, we'll start to see some of that, entry-level product start to get eaten up, which then will help people that are in those condos, as an example, or those starter townhomes move up through the asset classes. And then with that as well, I've definitely had some conversations with some people that are in homes that they feel are probably too big for them, and they're looking to right size potentially this year if the right product comes along. So for those people, it's more about, being patient and making sure that you find the right place to go to. It's not that they need to move, but they'd like to move and just kind of simplify. So it's just about finding that right product for them. But yeah, definitely having more conversations with people. There is some pent up demand, and I anticipate seeing that throughout the spring market here.
Yeah, well, great segue. Let's talk about where we think things are going to go. I think I read this, and correct me if I'm wrong, that projections for housing price increases are around low 3-4%, I think, for 2025. Now that's going to vary depending on not who you talk to, but like who's putting out the data. I can't remember exactly. I think it was one of the major real estate brokerages put that number out as their projection. I think it was 4%, if I'm not mistaken. And the reason I say that number is, do you see us kind of increasing in that regard? And let me say one more thing first, because we do our stats episodes, and it was 9 straight months that we saw housing prices come down across benchmark pricing, that is. And that was from March of 2024. So do you see us kind of increasing? Where do you see that going?
I think my prediction on our predictions episode was like 1 or 2% up or 1 or 2% down. Yeah. Spring market, people start, moving. You're going to see some better product on the market as well. So when the better stuff actually moves, could you see a slight increase in HBI price or, I through the spring market, I can definitely see that, for sure. I think 3 to 4% by the end of the year would be a big jump. If we continue to see rates drop or other things go on and confidence comes back, yeah, maybe I would probably hedge the under or take the under if it was set at 3.5, or even 3 for that for that example. But I would be pretty surprised if we saw that big of an uptick personally.
Okay, no, that's fair. So you mentioned the spring markets. Let's kind of circle back on that. Are we trending towards having not a traditional, because there's no such thing as a traditional in real estate, but a spring market in the sense that we're going to see some more activity kind of in those, let's say, March to May months, if I'm not mistaken? That's kind of when I would expect it, or even like into June, because usually summer tends to slow down unless it's an anomaly year. Are we kind of trending towards that, do you think, or are we just kind of going to be a steady kind of grind through the year?
My prediction is it's more steady. I think that you just really need to be really honest about, your price. I think you're still definitely seeing some people that are chasing prices from 2-3 years ago. I've been dealing with that with some clients on a purchase in particular, where all the data says that it should be here and person wants here, and I'm being told that the market's going to go up 10% in the next 3 months. And I'm like, good luck with that. But that's a conversation for another time. But I think you just need to be honest and realistic, and use the data to be prescriptive, and just, understand that there's a lot of things that go into value. Some of it is, obviously what a buyer is willing to pay for it. Some of it is, availability of other inventory. So it's important, if you're listing your place on the market, not only to look at what has sold in your area, but what is also currently trying to be sold. And I have that conversation with clients as well. I have a listing coming up, and the conversation was, well, there's a house that's a third bigger with a suite done that has a pool that's 5 minutes from you, and that one hasn't sold yet. So I don't think that you're with similar finishing. So, I don't think that you're going to be superior to that when I look at the attributes of your house. So it's important not only to look at what's sold, but also what's being sold, and kind of place accordingly within that market.
Right. Yeah, no, that's really well said. I think that we're optimistic. And I mean, I don't speak for both of us when I say this, but in general, we're optimistic about things getting better, but not to the sense that we think things are going to get crazy. We're not expecting things to just take off again. It doesn't make sense right now, especially like when I mentioned in my segment, like there's a lot of volatility right now in the market in terms of what's going to happen if we see tariffs, what's going to happen with just a new federal government potentially for Canada as well as for the US. Uncertainty can be a good thing for the market in some regards, but it can also typically be a bad thing. So yeah, we'll kind of see what happens with that. I think people are kind of cautious right now. I spoke to a client the other day, and he kind of brought up the Trump situation, because this is one thing that I will do, and I'm just gonna kind of pump my own tires here a little bit. So like, if you have a mortgage and I'm your mortgage broker, and there's a better rate available to you, I'm gonna do the math. I'm gonna figure about, okay, how much is it gonna cost us to break the mortgage? How much is it gonna cost? How much is it going to save you, and how does that kind of offset your cost of breaking the mortgage? And then I'm going to tell you, I'm going to be like, look, this is the opportunity for you. No pressure to do this, but my job as your mortgage broker is to make sure that I'm trying to save you money and pay off your mortgage. And that's one part of it, but it's also to make sure that you feel comfortable with the payments you're making or with the product that you're going into. So that's why the reason I say that is because I was speaking to this client about this exact situation. There was an opportunity for him, and I said, hey, look, we can save you some money. And he said, you know what, Cole, like right now I'm happy. Like I'm comfortable with where I'm at. I don't necessarily want to make any changes right now. I'm a little bit uncertain about what's going to happen in the market with the new US president, as well as whether or not there's going to be tariffs. So I'd rather kind of just stay where we're at, and let's revisit this. So that's just to say that like there is some sentiment out there that we don't really know what's going to happen in the next couple months. I think it's February 1st is the earliest that tariffs can go into place. Now, not to make this episode all about that, but there's more than likely that Canada would retaliate in some respect if the US does do that. I ultimately think the outcome that we're looking for here is a renegotiated trade agreement. That's really what we're trying to get towards between Canada, the US, and Mexico. That's really, I think, where Trump's coming from, to be honest. But anyways, the point of that is things can be volatile when there's uncertainty, and some people are going to be more cautious during volatile times. So I don't think it's unreasonable to expect things will kind of remain where they are now, if not even kind of slow down a little bit due to that uncertainty. Yeah.
Yeah. Very well put.
Yeah. Is there anything else you want to add before we wrap it up, I guess?
No, I think that's great. We'll have coming up soon another stats episode. We want to get Roman on. And again, we're asking you guys as listeners, if you would like to come chat with us and showcase your business or showcase your team, or want to share something cool with us. Always open to that. We've had great conversations with people, not even in the real estate world. Brody, Daniel, Richard last week was awesome as well. And that's just a short list of a couple people. But yeah, if you're listening to this and you want to come chat with us, we'd love to have you as well.
Yeah, absolutely. And last thing, we're going to start putting out more stuff regarding like Q&A. So if you have questions for us, we'd love to hear that. We kind of played with the segment idea today, Cole's Notes, but we're going to try to do some other segments. We're going to try to have a little bit of fun with it. So stay tuned for that. We'll try to still bring value, but also bring some joy and some fun with it as well.
Yeah, for sure. Sweet. Well said, Cole. Thank you for joining us for another episode of the Full Subjects podcast. And of course, leave us a 5-star review and make sure to subscribe if you haven't already done so. And we'll see you next week.